So you can see that there's a number of things conspiring, coming together, which are leading to a very, very acute shortage of silver. And we've already seen a lot of silver leaving COMEX. It's been drifting out of London for some considerable time. And I think that we're going to get another squeeze, which is going to make those 40% lease rates look like the foothills of a mountain.
This is Kaiser Johnson with Liberty and Finance. And these are the Miles Franklin Weekly Specials for May 4th through May 11th, 2026, while supplies last. First this week, 1 ounce gold South African Krugerrand are just $79 over spot per ounce. Next, 1 ounce silver Austrian Philharmonics are $4.99 over spot per ounce. And 10 ounce Dealer's Choice silver bars are just $2.99 over spot per ounce. And finally, we will swap 3/9 fine or better silver bullion for pre-1965 U.S. constitutional silver. This is an excellent opportunity to trade your generic bullion for U.S. minted legal tender silver with fractional sizing for greater versatility, all while keeping the full amount of silver ounces. Some restrictions apply. Call us for details at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finances. With great pride and pleasure that I welcome back this returning guest, Alasdair Macleod, a former bank director and the founder of his own substack. He'll tell us more about that later. It joins us today is Wednesday, May 6, 2026. Alasdair, thank you for coming back on Liberty and Finance.
That's my pleasure, DK.
I wanted to pick your brain about several things. The progress and direction of the conflict in Iran and what effect that's having on the global monetary and assets. Also, you've written recently about the likelihood of a major upward move being set up for silver. People in our subscribers would love to hear more of your thoughts on that. And also your concerns about the bonds, not just in the U.S., but all over the world, sovereign bonds being at a near crisis point. So can we start with an update on your view of the significance of the events that are unfolding in the Straits of Hormuz and the Iran conflict, and how that's impacting real things, real assets and critical materials, et cetera, and the prices of those worldwide?
I think the latest news is that the foreign minister for Iran did a trip to St. Petersburg, where he spoke to Lavrov and also Putin and brought them up to date. Now, following that, Putin apparently gave a call to the White House and warned them that if they attacked Iran, the consequences would be extremely dire for the entire region, and it would probably be a war that would spread further. Now, I wouldn't be surprised if that is why the White House, or particularly Rubio, seemed to back off, if you like, from the very aggressive position early this morning. Now, the suspension of Operation Fury, or whatever they call it, it got the oil price falling quite heavily, and also, if you like, sort of rather against what should happen, gold and silver rallied very, very strongly. I think that, however, this is probably just a pause. I don't see that any sort of negotiations are going to change the situation. And America is in the very, very difficult position now of having to try and sort of find a way of retreating from attacks against Iran without appearing to do so. In other words, some sort of, face-saving deal. Now, the Iranians are not giving them a face-saving deal. And the other problem is that if America does back off, it ends up leaving Israel exposed, which is very, very difficult to do. So, putting all this together, I think that there is a strong likelihood of a renewed military campaign against Iran. And I mean, we've got no idea in timing, but one of the things that will be a military constraint is that really in the next 2 weeks, it's going to start getting very, very hot in the Gulf, which basically means that it'll be very difficult for American soldiers to operate because they're not acclimatized to it. So that will put them at a huge disadvantage. I think that if America does attack Iran again, the response, which Iran has already promised, will be extremely severe. They've got hypersonic missiles, which so far they haven't used very much of, but they've got a lot of them. They have promised that they will basically wipe out all the infrastructure within the Gulf. We're talking about water desalination, which will make countries like Kuwait uninhabitable. And also the destruction of oil terminals and refineries and all the rest of it is going to put a permanent problem on the global oil supply situation, and also the supply of oil byproducts such as fertilizers and helium and all the rest of it. So this is extremely serious. I think that we are going to see this thing escalate again, I'm afraid. China is already making moves, if you like, to protect itself. She's now not exporting any commodities. And because she needs them, I mean, basically things like fertilizers and so on and so forth, she's just hanging on to. She knows what's going to happen here. As well as that, she's tightening down on restrictions on shipping. American ships can't visit Chinese ports anymore. And that includes Chinese ports or ports which China owns outside China. For example, Paris in Greece, Mombasa in Kenya, Djibouti at the Horn of Africa, and so on. So this is quite serious. And this, I mean, the excuse for this basically was America took control of the entry port and exit ports of the Panama Canal, which were owned by Hutchinson Whampoa, which is a Hong Kong-based company, and therefore in the Chinese sphere of influence. And they just took it. So this is the whole thing is escalating, and it's escalating not just from a Middle Eastern problem, but in a global problem. How rapidly that happens, we'll wait to see. But this is not good news. And I think that the consequences in terms of prices for much needed products, such as fertilizers and all the rest of it, as well as energy itself, is going to produce either a slump in America and Europe, or a very, very bad dose of inflation. And I think that in likelihood we'll get both. So that's going to drive up bond yields. And as bond yields rise, stock markets are going to collapse. The consequences for gold and silver are just slightly murky in the sense that the way the West responds to these things, I mean, if you get what we've seen recently is that when the oil price goes up, gold goes down. When bond yields go up, gold goes down. Now, this is, in a sense, I think what it reflects is the if you like, the Western response. U.S. portfolio managers, European portfolio managers, when they see crisis, their risk-free position is to get into cash. There's dollar cash, euros cash, sterling cash, whatever. However, in the Far East and throughout Asia, they take a different view. When they see a crisis, they want to get out of currencies and they want to get into gold or silver where there is no counterparty risk. And it's this difference in behavior which has been leading to a drain of physical metal out of Western capital markets towards Asia. So that, I think, in a nutshell, is really where we are in this thing. To my mind, the real thing that you should be watching, if you like, on a macro level is bond yields. They are on the verge of breaking out on the upside, which basically means that bond prices will fall very substantially. Some people are beginning to warn about this, incidentally. And the consequences for that will basically mean that debt traps on major governments are going to be slammed shut. And you'll find that America, Germany, the UK, France, and Japan will only be able to fund the expansion of credit by short-term borrowings, which will be, sort of T-bills and their equivalents. The idea of being able to market long bonds at anything like these levels, you can forget. And worse than that, the problem with the debt trap is that the higher the bond yields go, the worse the arithmetic is for the borrower. Then effectively they become unfundable. So that, in a nutshell, is where we are, which really is of great, great concern.
I wanted to circle back on several points that you touched on there. One was a passing reference to Iran calling to Moscow and that seeming to change the tone of Washington based on Moscow's cautioning about a regional expansion. Can you clarify what your understanding is of that? What role, other than Moscow as an ally or whatever, what role Moscow would have played in that materially?
Yeah, I mean, I am speculating a bit that that would have encouraged America to back off, if you like, and call an end to what they call it, Operation Fury, and say, well, we'll open it up and all the rest of it, which actually is a bit of a nonsense. But it is true that both Russia and China are involved in this, because there was an agreement in January between the three nations that they would actually work together. Now, this wasn't like the NATO Article 5, attack one member of NATO and the others, and you attack them all. No. This was really a sort of, if you like, a military and intelligence cooperation agreement. So behind the scenes, I think, as I understand it, Russia has been providing technological help, and China has been providing signals intelligence. So they've had a ship in the Sea of Oman, which basically has given very, very accurate, pinpoint accurate targeting for Iranian missiles. So they've had the cooperation on that basis. There is also this appreciation that if Iran is bombed out of existence, as President Trump says, and America succeeds in controlling Iran, then this is an existential threat to both Russia and China. And that must be prevented at all costs. So, that's really where this thing is so important. And I think that any warning from Putin, and, as I understand it, it was Putin who called. Normally he takes the call. For him to warn in this way, I think, is extremely serious and should not be ignored.
From your standpoint as an economist, do you imagine that part of the threat from both China and Russia to the U.S. may be financial or monetary, regarding potential dumping of treasuries, et cetera, not necessarily just military or logistical support for the adversaries as you've described?
Yes, I mean, I think that makes an enormous amount of sense. I mean, that's really where the quiet power of China, that's really, where she is most powerful, I think, and can really derail America as a whole. I think for her to go right down that route would be very, very destructive. And I think she would be reluctant to do that because, apart from anything else, she doesn't want to be blamed for America's misfortunes. She wants America to be blamed for America's misfortunes, if you like. So this explains why she's really not been, if you like, upfront in this problem. She's been doing things in the background which really haven't caught the headlines. I mean, one of the things is that America sort of produced I don't know whether it was an executive order or an actual law, but basically they commanded any company receiving Iranian oil, that they would be sanctioned. And what China has said is any Chinese company that obeys these sanctions will be breaking Chinese law. So now this is very, very serious. This is actually quite an escalation. It's not getting the headlines, but it is quite an escalation of the position. You referred to U.S. Treasuries. She did actually tell her private sector where they owned treasuries, and I think these are principally insurance companies, possibly also pension funds, that they should reduce their exposure to U.S. Treasuries. Now, I don't think in itself this amounts to very much as far as the insurance companies and the pension funds are concerned. I think it was more a signal, if you like, to everybody within the Chinese sphere of influence that she had this policy of discouraging anyone who was, call it, on her side. So we're talking about Shanghai Cooperation Organization, we're talking about BRICS, and we're talking about potential members of BRICS, whatever, trade partners and so on, that she was effectively discouraging investment in US treasuries. I think that was the signal that she was really intending. The problem which she may have is that if she decides to really sell down her US treasuries, it is possible that the US Treasury will refuse to transfer the stock, thereby not allowing the stock to be sold. So now, if that happened, this I think would be extremely serious. I think it would be a very serious financial escalation. Now, the reason I mention it is I do recall that when Alan Greenspan was head of the Fed, he said in an interview, because a journalist asked him, when you've got China as a major holder of U.S. treasuries, and China is seen, if you like, as not quite an enemy, but not one of America's friends. Did this worry you? And Greenspan said no, because we can always, if she wants to sell her U.S. treasuries, we can always refuse to allow her to do so. Now, I don't know if that thinking is in U.S. government circles, but if it is, and they attempt to do that, then basically they will kill the dollar without a doubt.
Yeah, I mean, you talked about this signaling, China signaling by its actions of discouraging retirement plans and insurance companies from holding U.S. treasuries, and that being a signal to all of their global network of countries that they're in league with. This would also be a outright sign if the U.S. refused redemption of treasuries by the Chinese to all other holders and globally of the U.S. treasuries, that you're on warning. You're holding a hot potato, and if China can't get rid of it, what are you going to do?
Well, exactly. And I can see the circumstances potentially where this would happen. If you were a funding crisis, the U.S. Treasury could well turn around and freeze foreign ownership of, maybe not just China, but foreign ownership of U.S. Treasuries, claiming that we've got a funding crisis and therefore we can't have any sellers in the market. I don't know. I mean, quite frankly, I think the administration has done some sort of really rather bizarre things. I think it would be silly to rule anything out.
Yeah, some of the hallmarks of the U.S. Treasury market have always been touted as deep pool of liquidity, instant liquidity, unquestioned, that sort of thing. But if you're starting to, if you have reasons to try to sanction others or whatever by locking out the ability of those to sell, it seems like a poison pill for that asset class.
Yes, indeed. But we're talking about a situation, I think, the inflationary consequences, or the consequences for the CPI index of what's going on now in 6 months' time is that the CPI index will be rising at a rate well in excess of 10%. I mean, it could be even more than that, because actually what we're seeing is not just, if you like, a shortage of this, that, and the other thing, and working through in terms of prices and so on. What we're actually talking about is a fall in the purchasing power of the currency. Now, when you can see that that is actually what's happening when prices rise, it's the currency going down rather than prices going up, then a loss of confidence in the currency is going to exacerbate that considerably. And that is the situation we face. If you have a funding crisis, it will result in a fall in the confidence of the currency. So it becomes a self-feeding thing. I just can't see that this is avoidable now. It's called a debt trap. We saw, I mean, if you look at the chart of the 10-year or even the long bond, you'll see that from just post-COVID days, the yield on the long bond rose roughly, I think, from 1 and something percent, 1 and a bit percent, and it went up to just over 5%. Quite quickly. And then we've sort of consolidated for the last 2 or 3 years, just moving sideways. We're going to break out of that on the upside. Now, having gone up something like nearly 4 times, we go up nearly 4 times from here. We're looking at a level of around about 20% yield on the 10-year bond. Now, I'm not saying that's definitely going to happen, but I'm saying that that is the prospect. Under those circumstances, who's going to buy US Treasuries? Not even domestic investors are going to buy it, except pension funds who will be looking, if you like, at the actuarial benefit of higher yields. The rest of it, forget it. It's just not going to happen. And this is at a time when America's debt to GDP is in the order of about 120%. I mean, we had this, DK, we had this in the UK back in the mid-70s. The crisis that we had was one of inflation. It was very similar to this. It was in the wake of the first real oil crisis when OPEC pushed up prices by something like 300%. Now, this time it's not such a sharp rise in the price of oil, though that is yet to rarely occur, in my view, but it is far more widespread in terms of its effects. Because in those days, in the 70s, they didn't have the refining capacity in the Persian Gulf. There was some, but there was very little. The result was that all the derivative products from oil and gas basically didn't exist in the Gulf at that time. So it wasn't a supply shock for all those products. But this time it really is. So this is widespread. So even though the price of oil hasn't yet gone up 300%, it's only gone up 100%, it will probably go up somewhat more. So it could well go up 200%, maybe even 250%, I don't know. But even on what's happened so far, we're going to see what happened back in the 70s in the UK. Now, in the UK, we ended up with a sterling crisis. We ended up with bond yields rising to 17%, would you believe? 17%. The IMF came in and had to bail us out. And we were very lucky because then we discovered North Sea oil. Suddenly we were a petrocurrency. I mean, this was just, you know, the luck of the Irish, as they say, but the luck of the Brits. So this was absolutely amazing. The other thing which was key in this was that the debt to GDP, government debt to GDP, was in the order of about 35%. Now it's 100%. We're seeing a rerun of what's happened in the 1970s. But instead of 35% debt to GDP, we're now 100% debt to GDP. There really is no way in which we can expand our borrowing from there. You know, this is really the situation. So what does this translate into? It translates into a valuation for currencies, which is not just us, it's the whole of G7, it translates into a problem for the currencies, for the governments that issue these currencies. They will not be able to fund themselves almost at any price, except through very, very short-term debt, like 3-month T-bills sort of thing. So it's printing cash, if you like, on the debt side and cash on the output side. And what's that going to do to the further confidence, if you like, in these currencies? Is going to undermine them even more. I mean, I think what we're seeing is something that's tipping us into something which is going to be almost impossible to get out of.
Your correct focus there on the realization by enough people that the crisis that is evidencing itself in the failure of the debt market by the skyrocketing of sovereign bond rates is actually going to cause, or is a symptom of, is certainly going to cause a destruction of the value of the currency at a rapidly rate. But it seems like in the past, at least in the U.S., it has been shocking how delayed the public awakening that it's the currency declining, not prices rising. Even back when we had Nixon, he did a 90-day price freeze on all prices, and Biden was saying, oh, it's corporate greed, doing all this shrinkflation and everything. Never from the halls of power have come the confession that actually it's from collusion since 1913 of the central bankers with the government and the treasury that we've been destroying your currency, and this is where the symptoms are showing up. Do you foresee an actual widespread enough awakening on the parts of enough people that there will be this mass recognition and acknowledgement? The emperor has no clothes, the currency, the cash is trash, and people will fly to something other than the dollar?
Eventually, yes. I mean, this is described by the great Austrian economy, Ludwig von Mises. Basically, from his experience of what happened in Austria in 1922, Germany 1923, was the last people to understand what was going on with the users of the currency. Until the very last moment, they think its price is going up rather than the currency going down. But when they finally realize that it's the currency going down, then the currency will not recover. It's the end of the currency. So that, if you like, is very much the last thing that will happen. And it's characterized by people just getting rid of currency for anything. What he described, or what's described in German, translated into English as the crack-up boom. In other words, finally, there's sudden demand for everything. But that demand is a desire to just dump currencies, get out of it, before it's completely worthless. So that is the last thing that we will see. Meanwhile, I mean, I just feel that it's my task, and it's really through your good offices, to try and make as many people aware that this is what's going on before they get to that final point and then say, I now understand what is going on. By then, the dollar will be, you'll need $1 million to buy a cup of tea. I mean, it's going to be a bit like that. So understand it early, really follow the process, understand the implications, understand how to protect yourself. And you won't be one of those people, the general public, who suddenly wake up at the end of a process where their medium of exchange is being completely destroyed.
First, a little joke and then a serious topic. At that time, when the public wakes up and there's this flurry of economic activity going on, what is your prediction that the official halls of power and the government mouthpieces in the mainstream media will be saying, wow, look at this wonderful economic activity. We're having an economic recovery. All is well. It's back to happy days are here again.
Well, undoubtedly, I think a more important point is that we've got to understand that there's a process that's not going to be stopped by reason, by economists giving correct advice to government and all the rest of it, because the whole process is driven by politics. It's politics that matters. So when you have a situation where the government can either stop the rot and tell everybody, sorry, no more welfare, or we're cutting welfare, or whatever it might be, we're cutting out right back to the bones, we're going to balance our budget, etc., so that we've got a surplus. We're going to secure the value of the currency, but it's going to mean that businesses go bust in huge quantities, or we'll just put it off a little bit more. What are they going to do? Politicians, they will do the latter. Always, always, always. And the great lesson from the German hyperinflation following the First World War was that there were in the government economists who had a better grasp of what was going on than the current economic establishment. They were all part of the whole system of the collapse because it was driven by economics. And indeed, Karl Helfrich, who at one stage was a finance minister during the First World War and subsequently was still very close to the government and advising government ministers and all the rest of it, he knew that this was happening. He knew why it was happening. His status as an economist was similar to that of Keynes, for goodness sake. He was the man who also devised a way to get out of the problem eventually. It was slightly different, it worked in a slightly different way. He came up with a plan to base the new currency on the value of Germany's corn output, which was a similar sort of thing to the eventual solution. But even though they were better advised, the politicians of the day were considerably better advised than, say, the Trump administration or any administration that might follow the Trump administration or precede it. Germany still destroyed its currency. It was inevitable. And that, I'm afraid, points very clearly that our experience is unlikely to be any different.
You've written recently about the appearance that the silver market is poised for a potentially large positive move. Any additional light other than what you've already explained about the destruction of the currency and so on that you'd like to share that guide you to think that people should keep their eye on silver in the near term?
Yes, I mean, silver is unique insofar as, unlike gold, it's also got an industrial, like a major industrial use. Gold has a minor industrial use. And that is, obvious. And that use is, if you like, not really dependent on economic activity. It's mandated by governments that, we've got to move away from fossil fuels and all the rest of it. So you've got EV, photovoltaic production. You've also got electric vehicles and so on and so forth. And obviously we're seeing defense expenditure rise. None of these are sort of things that, if you like, die with the economy. I mean, they are the last things to die with the economy. So demand for silver for industrial purposes is really what's led to this supply deficiency over the last 6 years or so. And now that China has changed her attitude towards trying to suppress the price in the West, what's happening is that you're getting a growing amount of interest in silver as a monetary metal. And that, I think, is only just started. It's leading to, if you like, a crunch whereby the shortage of supply over the last 6 years suddenly is going to become very, very acute. The gap will not be filled by China. We've seen silver imports, China's silver imports in the first 3 or 4 months of this year. There's been, record levels. I mean, there's something about their exports. They have been exporting some, but I don't know that it's been anything like what they've been doing in the past. And I think what China is doing, she's been reviewing her export policies quite significantly in the wake of the Iran war, the Gulf War. We've seen this with things like fertilizers and so on and so forth. And other people I've talked to who know better than me about Chinese policy, trade policy, they're saying that they're tightening up on all their commodity exports. We've seen this, for example, with rare earths. We saw this back in late September last year I don't think it was telegraphed at all, but we could see that something similar was happening with silver, because literally within about 2 weeks, there was a liquidity crisis in the LBMA, which drove silver's lease rates up to roughly 40%. And China is now in the situation, because America turned around and suddenly decided I think it was about the last half of last year, that silver was a critical mineral and they needed to accumulate it. Now, was China going to supply this to America? No way. So you can see that there's a number of things conspiring, coming together, which are leading to a very, very acute shortage of silver. And we've already seen a lot of silver leaving COMEX. It's been drifting out of London for some considerable time. And I think that we're going to get another squeeze, which is going to make those 40% lease rates look like, if you like, the foothills of a mountain.
Alasdair, for people who want to follow your ongoing analysis on a more frequent basis than your visits here on Liberty and Finance, for which we're always grateful, how should they find your Substack?
Well, all subscribers to MacleodFinance.com are very, very welcome. And I think in these really very dangerous times, it's extremely important to have the right sources of information. So I encourage everyone to sign up. I mean, you can be a free subscriber or a paid subscriber, but get the information. That's the whole thing.
We're always grateful for your visits here, Alasdair. Thank you for taking time out. As you're based in the UK, it's evening for you, and we're grateful for your presence always here on Liberty and Finance.
That's very much my pleasure, DK.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 4th through May 11th, 2026, while supplies last. First this week, 1 ounce gold South African Krugerrand are just $79 over spot per ounce. Next, 1 ounce silver Austrian Philharmonics are $4.99 over spot per ounce. And 10 ounce Dealer's Choice silver bars are just $2.99 over spot per ounce. And finally, we will swap 3/9 fine or better silver bullion for pre-1965 U.S. constitutional silver. This is an excellent opportunity to trade your generic bullion for U.S. minted legal tender silver with fractional sizing for greater versatility, all while keeping the full amount of silver ounces. Some restrictions apply. Call us for details at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.